Hello everybody, it's Greg here from Ragosa. I hope you're all having a wonderful start to the week. And I hope to earn your like and subscription today. This video here, I just want to touch on a quick short strangle that I entered into. Entered it into APA. APA is an oil company. What the company's name is, I can't remember. Let's just look again. I should probably put this in my notes, but you know, that's not the style of things we do. While that waits, I'll show what the strangle is that I have on the board right now. We'll build that up. APA. Oh, APA is just APA. Yeah, isn't that easy? Huh. Cool. All right. So yeah, it's an independent energy company. They've got operations in the United States, in Egypt, in the UK. They're trading right now. They had a huge lift today, which is what got in. And I can get that in a moment. But I got turned on to APA from an investment advisor. Who, listed in the video that this was a stock that he was keeping an eye on. So I thought, you know what, let's keep an eye on it as well. My trading is, more volatility based. I usually don't take directional bets or anything like that. But, it's nice to know what other people are looking at. And, what directional bets aren't always a bad thing to do. In this case, when that fellow made on the announcement, I believe the APA was trading around $36. It's now trading at $41. So that is a very nice gain from that video. That we're looking at about 14.5 some odd percent. So not bad. APA moved up roughly 8% today. In the first 5 minutes of trading, it jumped about 2.5% on roughly 20,000 shares of volume, and then it just proceeded to grind higher until topping out at around 8% at the end of the day. Here we can look at the 5-minute chart to give a look. So yeah, here we go. You can see this quick little bump here, about a quarter or whatever, and then it moved up about 5.4%, something like that, over the rest of the day. About 200,000 shares first 5 minutes, and then huge volume came in right at the back end. That's going to be kind of important, and I'll get to that in a moment. But what happened was an analyst came out and repriced, reset a target for APA. Which one was that here? Was it the Roth Capital? No. Trust Securities was just on a hold. What happened? There was an analyst news. Anyhow, there was a repricing, and they're like, this thing seems pretty awesome. Everybody should pick it up. I think, if I remember right, on the investment manager's video, the book value per share was something like 15 or 17, and right now it's showing 20. So, it really jumped up. But yeah, anyhow, that's enough of the fundamentals. If someone wanted to trade this based on fundamentals, could there be more upside to this? Quite potentially. Apparently, they are reworking their structure and reworking some of their debt and things like that. They've got some good assets. Some good capex and stuff going on, but that's not really what we're looking for here. What we're looking for is nice quick vol play. So on that 8% move that we had, that's going to really juice calls, and there's a significant amount of call skew in the market right here that, look to take advantage of. And ideally, it's like, okay, well, we have a systematic repricing of the equity. When you get an 8% move and total volume on the day was somewhere close to 7 million shares. Usually this thing trades around 2 million shares, 2.5, something like that. It was a significant, this volume chart here on the day does not show the blocks that came in afterwards for the dark pools. Like it doesn't have this huge 800,000 share block that came in after cash close. But anyhow, so we're throwing on short Strangle here to just really capture some consolidation at the end of this major move. And it seemed pretty nice. Right now, the bid ask is 146 to 120. I got in at 130. I had to leg in. I'm getting a lot of kind of adverse selection. It's just kind of what the diagnostic from the last Vegas scalping that I was doing. Just kind of realized, hey, there's trying to work with the consolidated order book, the COB, is just really hammering me. The fact that I actually had to cross, or the best book offer crossed my order by 1 or 2 ticks, is a huge red flag that market makers that have the discretion to trade with me are not wanting to trade with me, or at least were not wanting to trade with me at that moment. To give you guys a little bit of market structure insight, all your accounts are tied to a specific ID, and major market making firms, major trading firms and stuff like that, they all have a basket of IDs to work with. But us as single retail traders, we have one ID unless you've got like a couple accounts, but the fact is you have a finite number of IDs unless you keep rotating out these accounts and having a basket of them. So anyhow, if you end up getting systematically good entries and good exits, your ID will end up getting flagged. And when people talk about market makers like hunting stops and stuff like that, they don't. What they 100% do though, because they do this to each other, is that they will look for these IDs and they will, pull liquidity, widen spreads. They will fight with you on order entry and exit. And that fighting is why major institutions rotate out these IDs, and on the VWAP or the TWAP order execution algos, major institutions can actually fire off those orders through a variety of IDs to try to mask their actual footprint on the tape, to make sure that those orders are not being they're not being sniped by the market maker, because the market maker is looking at that kind of institutional VWAP or TWAP execution as being adverse order flow to them. So anyhow, a little bit of market microstructure there for you guys. So anyhow, I legged in, and I can't remember exactly what the bid ask was on entry. I think it was kind of like 142 or something like this, and 123, maybe. What I do remember is that the mid price was being set at around 128, and I managed to get it at 130 by just legging in, and I had a 22-second delay because I am slow. I guess I'm like boomer slow on clicking the buttons on order entry. I could fix that by really putting a crazy price on the initial submit order and then working the book, which is I think what I'll do later on, just so I can, you know, get 2 orders in there, and then I can, you know, fill those legs within 2 or 3 seconds of each other, you know, or maybe 5 seconds of each other instead of 22 seconds of each other. Whatever. Effectively, there wasn't a lot of volume. Well, there was a decent amount of volume, but at the time that I put it in at 15:53, we had what is this? A high of, that's 55. A high of 41.10 and a low of 40.90. The mid was 41. I think I got it in around 41. I can't remember exactly what the stuff was doing, but basically legging in on this got a way better fill than what I would probably have gotten if I was to route it as a combo and run in the consolidate, or in the COB, blanking on that consolidated order book. Anyhow, combo order book, I don't care. Anyhow, COB. The place where the market makers have the discretion to take your order or not, and you are no longer a liquidity provider, you're no longer making a market in volatility, you are now purchasing, or like selling, but actually purchasing the structure from the market maker. It's kind of weird to say you're purchasing a negative thing, like you're purchasing a sell, but like essentially you are. You're not forcing the market makers to make a market with you. You are interacting with them and taking what they are giving you. So you can see on my trade confirmation here, I have it set on, like, it filled through 2 different exchanges. And so you can see here, you know, I interacted with 2 different market makers to create this Strangle. You know, I quite literally created the market for this short Strangle at that point in time. Anyhow, yeah, fun stuff. Let's talk about the trade a little bit, what I'm in here for, and the whole idea of what's going on. I am in this trade here where August 10th, I think WASD is coming up on, it's either the 12th or the 19th. I should really know this. But excuse me. My point here is to grab a little bit of Vega collapse, IV collapse, and run home. August 12th. Okay, yeah, so this Wednesday. So, you know, we've got 3 days here. Do I think I'm going to get 10% over the next 3 days? I might. We're going to see what it comes up, what it's printing tomorrow morning at open. You know, if I'm able to close this thing out for 15 cents of premium capture. Oh, did my thing just die? It did just die. Huh. Let's try to... Here, I'm gonna pause it. Alright, well, whatever. We lost the webcam. Not important. We don't need it. You don't need to see my beautiful face anyways. Or I guess you do. It's just gonna be frozen up on that frame. What does it look? At least I don't look like an idiot. Well, I don't know. Up to you to judge. So yeah, we're just in here for, you know, 3 days, maybe the end of the week. We'll see. We'll see what WASD comes up with, because at the moment the micro E-mini cash settled futures options are still not available for trade at IBKR. So, you know, we're sitting on the sidelines, and I can only sit on the sidelines so long before I need to put money to work. So we're putting money to work in APA. Couple day hold. This could be a pretty decent, full on Strangle to hold down to 50% premium capture or something like that. But I'm just looking to put some cash to work for the short term, and then probably get into trading some corn into the harvest cycle. So if I start doing that, I'll make some videos on how I'm trading corn, and that could be cool. But anyhow, let's talk about APA some more here. So we had this huge bounce, and now this chart here, look, it's a 6-month, 4-hour chart. So the SMA showing 200 is really a 100-day SMA. Whatever. So 100 day is pretty good. 100 day is definitely not as good as a 200 day to try to look for a structural bounce. The 100 day might as well be a 90 day. 90 day is still a significant number though, so it's good enough. So we're in with our put strike at 37.5, which is essentially the 100 day SMA. That's not bad. Our call strike is 47.5, so we're all the way up here. We're looking at 14.75% before our call testing before we run into the money. And given that we collected $1.30 of credit, APA essentially needs to run like 20% to breach our call and premium before we really start to get into hot water. So we've got a lot of room to potentially manage this if we get stuck in a multi-day or multi-week position. So we'll see how it goes. I'm not too concerned about that, although famous last words. Looking at the 4-hour 1 month, it gives us a little bit more granularity here. You can see this just huge run that really started back on what was this, August 6th. So if anyone got in there, I mean, that's, you hit the bottom up there, you're like 17.5%. That's pretty nice for stock trading. But anyhow, we have this APA short strangle in, and we're gonna see how she does, and hopefully I can get some live action on closing this position out when the time comes. Is there anything else that I need to show you here? Oh yeah, so one of the reasons why I went for the short strangle instead of some other structure, looking at the term, the weeklies here, we've got the 4-day, it's 46.7, 11-day 43.5. This is all on IV. We've got a little bit of an IV spike, the 18 at 14.4, and then 25 is 44.8. And then 43.7, and then we're into 44 on the 39. So if you look down onto the bottom left of the screen here, you can see the vol curve, and we've got this isn't the best because this is done by strikes instead of term structure. But if you kind of look, we're in a little bit of, well, actually that's just the monthlies, that's not showing the weeklies. With the weekly numbers that I just rattled off, we've got a little bit of backwardation, or I guess I'd call that a decent amount of backwardation in the front, the front weekly structure. And then once we start moving back out into the monthlies and the quarterlies, we're getting back into contango, which is really nice. So if we need to roll any of the positions out in time, we are rolling into a higher IV environment rather than a lower IV environment. So that is going to be beneficial for our roll. We'll be able to collect more credit on the roll, or roll to a more advantageous strike if we wish. So it's super nice as far as adjustment management goes. Also, it's psychologically nice to be selling $1 worth of credit, or a little bit more than $1 worth of credit, rather than going shorter in time. And collecting less credits. I was looking at the 11-day for something, and looking at the 20 delta, roughly 20 delta Strangle on the 11-day. Right now, these markets are super wide because it's a close, but they weren't much better, honestly, during the last few minutes of the day. Essentially, the bid ask is 40 cents wide. It's like 50% of the range is in the spread. That is just far too large to cross. You're gonna get killed, and I was like, there's no point in doing that. And then I thought, okay, well, what if I run the call ratio spread? And I didn't like the idea of picking up more expensive long call delta, more expensive being like higher IV. I didn't like the volatility environment for picking up the long leg and then trying to sell the short leg. I thought in that I was going to get too much gamma exposure, and essentially my hedge, my long hedge, or long exposure, was going to be too expensive. And then, given how this market is pricing itself, trying to structure a zebra in the quarterlies. Now, it doesn't necessarily need to be a 70 delta, 50 delta zebra, but anyhow, just doing the zebra structure, given the width of the spread here, I thought I'm giving up too much. I'm giving up too much to get into that structure, and I don't like it. So just kind of working through all the different options of all the different structures I could do to capture this volatility, because I don't want to play a direction at the moment. If I was going to play a direction, I would want to wait a couple days to see how this trend, or what happens in the stock. Does it consolidate a little bit? Does it keep on trending? What happens? If I'm going to be in here for a couple months or a quarter or whatever, I want to have some more visibility, or especially if I'm going to be in here for a year. You can give up a week of time just to see what happens, because you're doing a totally different game than trying to trade the volatility. The volatility is more like what's happening here and now, rather than what's going to happen over the next earnings cycle. And if I was going to look at the whole next earnings cycle, honestly, with the width of the spreads here, I might almost want to look into picking up some static delta with the stock, or something. I mean, I don't know. Ultimately, this is not the best thing to be trading some of these strategies with, but you know what? It works well enough for trying to get in a regular volatility strangle, in the monthly cycle. So we would go with that. But conceptually speaking, if I wanted to go pull up a zebra here, you can see we've got basically $1 worth of spread at the 70 delta mark, and we don't have a lot of strikes to work with here out at 130 DTE. So it doesn't give us very much breathing room. What I would probably just do is a straight up poor man's covered call, accept some of this theta and an IV, premium, just to have some defined risk in the position. Um, and I would probably go and look at whatever would give me the tightest spread. Um, and at the tightest spread, we're looking with a decent amount of delta, trying to buy deltas with the tightest spread and the least amount of extrinsic value cost associated with it. Probably just buying the 40 call here. This is 65 cents of spread. And if you look at the 51 delta, this is 35, 45 cents. So we're picking up 9 extra deltas for, I don't know, 10 more cents, like a dollar a delta. I mean, I don't know. I mean, pick your poison. One thing I would not do would be running to the 42, just because you're paying a lot of extrinsic value for that. I don't think it's worth it. At 40, we're paying roughly, three or one, yeah, four, somewhere between $3 and $4. It's just, it's hard. I don't like any of them, which, it's like, choose what method you want to get killed with. Do you want to get knifed? Do you want to get shot? It's like, well, I don't want to die. That's kind of the deal that we're playing here. But yeah, no, I'd probably just pick up maybe like the 60 delta and run a poor man's covered call if I was going to play a long-term bet on this. So like pull up the 60 and maybe sell the 43, 43 at 11, because 11's still pretty juiced. But the other thing we could do here is, well, I mean, this is pretty wide. Might as well just go to 11. Could go to 18. Look at what the 18 day is at. Sometimes selling the 30 delta on the poor man's cover call is a good idea. But I don't know. Push it out an extra week. Do you really get too much to go from 75 to 44 for an extra dollar? No, not really. Not really. And you can always roll the thing out anyways. So if I was going to do a poor man's covered call for a long-term position, I would probably do this thing right here, right now. And funny enough, I could route this thing and decrease my margin. Huh. It always surprises me when, like, I mean, I should be able to figure that out, know it intentionally or intuitively, but it always just surprises me when it's like, oh, I could do this. I could add more stuff into my account. Well, no, wait, it's going for that. Well, yeah, it's decreasing the margin impact by like nothing, by peanuts, because I'm paying probably $4.50 to get in there, $450. But whatever, that's $450 of cash out. And side note, that cash out is super important to keep in mind when you're trading with span margin, because you really need that cash buffer for the changes in your margin calculations intraday. It gets significant. If you only run on what your change in margin impact is, you can very easily over leverage your account. So don't do it, guys. Don't do it. But anyhow, yeah, throwing this thing in would, over leverage my account. My excess liquidity is $1,700 right now. Like, do I really want to go throw $450 in cash out there to get it done? I mean, I don't think so. Let's just for argument's sake though, let's see what this would show. Yeah. 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 I mean, the equity with loan. That's the thing. That's really the serious part. The equity with loan is coming down, and you do not want your equity with loan to get low. That's what causes your margin call. Anyhow, that's I totally sidetracked myself. But yeah. Anyhow, that's this APA Strangle. And we'll see how long it takes us to close it out. Hopefully we capture a few points, and hopefully we can do it in time to throw in a corn trade Wednesday morning. WASD comes out at like, I think 10 o'clock, 9 o'clock Pacific, something like that. So like noon Eastern time. I think it's like an hour before the egg futures close. But yeah, I don't know. We'll see. We'll see how it goes. I need to brush up on what's all been happening in corn and stuff like that. So it gives us a few days of trying to figure out what's going on. And in the meantime, hopefully we make some cash. So yeah, that's this. Thank you for sticking around. I rambled on for a whole lot in this video here. We're just past 30 minutes. But anyhow, thank you, and I hope to see you again in the future. Have yourself a wonderful evening. Bye-bye.